Good evening, everyone. Uh, like Abhishek was saying, this was a very pivotal policy for the bond market and generally for the economy as a whole. And let me start with a bit of context on this. For the last few quarters, what we have been very focused on is the fact that India's balance of payment has been struggling, and this is despite us having a relatively narrow current account deficit. So historically, we always used to say that 2.5% of GDP current account deficit is very much financeable in the context of India, because we used to get net capital flow from abroad amounting to around 2.5% of GDP. Somewhere in the 2023-24 period, our current account deficit actually started declining to the extent that it narrowed all the way down to between 0.5 to 1% of GDP, and that was largely related to a rise in our services trade surplus, courtesy the Global Capability Center phenomenon. However, although this was supposed to be a bond positive phenomenon, because a lower current account deficit automatically almost translates into a bullish feeling for bonds because the savings investment gap is narrowing. However, what we witnessed over the last 4 or 5 quarters, in fact, a little more than that, is capital flows into the country started struggling quite substantially. So that even with a 1% current account deficit, we started posting a negative balance of payment. In fact, FY25 and FY26 were two successive years where India posted a negative balance of payment, which meant that we net lost dollars or capital to the rest of the world. Now, uh, what this leads to is what in financial market and economics is known as the impossible trinity phenomenon, which basically means that, especially in an emerging market context, when you have a negative balance of payment or a capital account that is under pressure, and you have therefore a currency that is witnessing pressure, and India's rupee has for the last couple of years been facing pressure, then monetary policy struggles to remain independent, and it struggles to basically determine interest rates in a fashion that they respond only to local growth inflation. And that's precisely what was happening in the case of India as well. What we saw over the last 1.5 years is that despite RBI cutting rates all the way down to 5.25% on the repo, market yields actually started to go up, especially since mid of last year. And this was almost across the board. So you could argue that, long rates had different dynamics and short rate had different dynamics. But, for example, till a few days back, you had almost every sort of market rate ranging from 3-month bank CD to 40-year government bonds, which were all in the vicinity of 7 quarter to 775. And that to us was a classic manifestation of the impossible trinity phenomenon, which is that despite RBI guiding lower repo rates, market rates had stopped responding to it. And therefore, for the last few months, our guiding principle on market view has been this balance of payment pressure. And therefore, we have managed duration very actively across our product basket. Now, the start of the West Asia war, because the going in biggest problem for India was balance of payment pressures, had also to be looked at as accentuating the pressure on the balance of payment. So yes, the West Asia war via higher commodity prices, etc., would lead to higher inflation. It would lead to lower growth. But those are all manageable aspects from a monetary policy standpoint as far as RBI is concerned. What is what was proving more difficult to manage is this additional pressure on the balance of payment because of higher trade deficit, lower remittances, lower capital flows, etc. So in some, the BOP pressure was further accentuated because of the West Asia war. And therefore, what has been very important over the last few months is for policymakers to start to get ahead of this balance of payment issue via capital flow measures. And that was always supposed to be some turning point for the Indian market. And therefore, over the last few months, we have not been as focused on whether or not RBI should be hiking rates because of inflation going up, but rather, can steps be taken to manage India's balance of payment situation. So this is the context with which we entered the policy. And just a note there. So why we think there has been balance of payment pressure or lack of capital flows into the country even before the West Asia war started? There are two primary reasons that we think have been responsible. So over the last 1.5, 2 years, you have seen average global interest rates move up, and they seem to have moved up sustainably, which means that US bond yields are in the 4.5% area, but US economic growth is still doing fine. It doesn't seem to be minding the higher level of interest rates. So therefore, for any global allocator, the threshold that you have to beat, which is proxied by the, let's say, the US sovereign rate, has now gone up. So therefore, if you're investing into an emerging market like India, the threshold expected return that you have to beat is now higher. So that's one thing that has changed in the world over the last 2 or 3 years, which did not exist before. And the second thing, which is an obvious point but sometimes underestimated, is this whole alternate capital allocation themes that are doing the rounds around the world, chiefly the AI capex as well as AI company investments. So, you see a lot of these AI value chain companies, which are now between 1 and 5 trillion dollars of market cap, and they are growing just fine. And therefore, global capital has a host of options around the world to deploy itself in. So not only are global interest rates higher, but there are global alternate themes also, which seem for the time being quite persuasive. And we thought these two were to a very large extent responsible for India not getting enough capital flows over the last couple of years, despite very sound, very healthy macros. So again, to summarize the situation entering into the monetary policy, so the primary concern for us has been the balance of payment pressure that India has faced almost for 2 years now. This is despite good local macros, but owing to higher global interest rates and alternate themes for global capital that have been drawing capital elsewhere. So, despite good macros, we have not been getting capital flows. The way it has manifested in the local financial market is, despite RBI cutting in interest rates, doing quantum open market buyback of bonds, despite for a long time them guiding lower for longer interest rates, market transmission had stopped and had reversed because of the impossible trinity issue, which is you can't simultaneously have pressure on the external account, pressure on currency, and still have independent monetary policy. The West Asia war, we looked at first and foremost as accentuating the balance of payment pressure. And therefore, it was very critical that the government and RBI respond on this fundamental issue of balance of payment. And that is how the setup was going into, let's say, this week. Now, the very happy news is that both the government and RBI have completely delivered on expectations with respect to capital flow measures. So let's first get the traditional points out of the way. So repo rate was kept constant, guidance was left, or rather, the stance was left unchanged at neutral. However, the governor very clearly said that there are latent inflation pressures building, and the monetary policy committee will stand ready, will remain data dependent, and should inflation pressures remain persistent or exhibit second round effects, then they would probably act on this as well. Now, it needs to be said and understood very clearly that repo rate hikes are the last of the bond market's problem. So nobody at all almost on in the bond market expects RBI to not hike. Everyone thinks RBI will have to hike. Our own view is that you should, as a base case, assume roughly 75 basis points of repo rates to be hiked over the next 1 year or so. And this will be only to address the fact that average expected inflation has moved up because of a host of things. So it is the West Asia war and it imparting upward pressure on commodity prices. It is unfortunately the forecast of a very weak monsoon because of what is being called the super El Nino. And that may additionally exert pressure on food prices. So, for a variety of reasons, as opposed to last year where inflation would have averaged at 4 or below, this year it's very likely that inflation averages 5 or higher. And therefore, it's absolutely okay for RBI to hike, but only for inflation reasons and not for currency protection reasons. And this is where the important line needs to be drawn. because there has been a view in the market that because the rupee has been struggling, RBI may have to hike rates to protect the rupee. Now, the point there is, unlike in 2013, when RBI indeed had to hike rates to protect the rupee, the context now is very different. You are sitting on a pre-war inflation which was close to 4%, a pre-war current account deficit which was less than 1% of GDP. So therefore, the economy was showing no signs of overheating or imbalance. Contrast this to 2013, CPI inflation then was 10% and current account deficit was 5% of GDP, and there was no war going. So clearly it was an internal imbalance issue that the RBI was forced to rectify via rate hikes. Such is absolutely not the case today. So one has to distinguish between RBI modestly hiking by 50-75 basis points because of inflation reasons, and RBI having to put an aggressive interest rate defense for currency reasons. So to be clear, we expect the former but not the latter. And the important point there is, because of the balance of payment pressures of the last 4 to 6 quarters, market interest rates have risen to a level where it's almost irrelevant to the market whether repo rate is at 5 quarter or at 6%. So yes, the very shorter end, money market rates may respond if repo rate is high, but you look at anything at all, even look at 1 year bank CD, or look at 3 year, 5 year corporate bond, or look at, uh, you know, 14 year, 40 year, 50 year GSEC, nothing is getting priced off the repo rate. Indeed, even at 6% repo rate, these levels would look quite attractive. So therefore, the very important thing to understand before we cover measures taken in the policy is that, owing to this balance of payment pressure, market yields have risen to a level where the relevance of 5 quarter repo rate is almost non existent. And the only ask that the market has is that whenever the RBI MPC embark upon a rate hike cycle, they do so in a gradual fashion so that the expectation with respect to future rate hikes does not get unanchored, which plain speaking implies that today, for example, suppose we expect 75 basis points of rate hikes to happen. RBI MPC should not communicate future rate hikes in a manner that we suddenly start fearing 125 basis points rate hikes. So that's the only ask that the bond market has. And so long as the balance of payment pressure is addressed, market rates are actually looking very fine from a valuation standpoint. Now let's turn to measures announced today. So, we started actually with Government of India taking a very strong measure with respect to government bonds. So they have basically, for FPI investors, nullified all sorts of taxes on income from government bonds. So there were two taxes. One is withholding tax on coupon income, and the other is capital gains tax on capital gains. And both have been nullified. This is much above any sort of market expectation with respect to the point. So market expectation was basically around this, that they may tweak capital gains and withholding taxes, but they have gone ahead and nullified that. So that's a very strong statement of intent from the Government of India with respect to FPI participation in government bonds. RBI, on its part, on this same issue, has elongated the list of what are known as free access route or FAR government bonds, so that there is more easier entry and exit. And they've also tweaked some aspects of the general limits that FPIs have for bonds. But suffice to say, in summary, that between the RBI and government, they have made it much more easy and efficient for FPI investors to participate in local government bonds. Now, the point is, you could still argue that not much inflow for the immediate future is expected via this route, even with taxes having been nullified, or alternatively, some bit of money could very well come. However, the way we are looking at this is, first and foremost, it signals a very strong statement of intent from India's sovereign that we are now willing to do whatever it takes to address the balance of payment issue. So one should not doubt the intent of both the sovereign as well as the RBI. Second is, this nullification of taxes greatly enhances India's chances of getting included in large global bond indices like the Bloomberg Aggregate Index. And if that were to happen, then automatically you will get resumption of bond flows into the country from the FPI community. You would note that in the last 2 years also, while equity FPIs have offloaded a lot from India, bond FPIs have largely held the faith also because they were not very heavily present in the first place. However, so this first set of measures taken, which is government nullifying taxes and RBI tweaking or making it more easy for FPIs to participate, is a very, very notable sign or signal that both have given to the marketplace. The second, and again where people got pleasantly or positively surprised, is on fresh issuances of FCNR deposits by both public and private sector banks up to 3 and 5 years. The RBI is basically saying that they will cover all the hedging cost on the USD INR. So again, the expectation earlier was that RBI will subsidize the hedging cost. So let's say if 3% is the hedge cost, they will take half of that. Nobody had thought that they will take the full hedging cost on themselves. So now banks are free to basically price their dollar deposits at whatever rate they will get money at, and they don't have to pay any hedging cost on the conversion of USD INR 3 or 5 years later when they have to return the dollars. And that's a very, very big step, and it helps in two ways. First is, it helps shore up dollar flows into the country, and second is, as those dollar flows come and sit as deposits with the banking sector, this funding stress that the banking system has been lately feeling, which is why money market rates and front end corporate bond rates have been higher, that immediately gets taken care of. Which is where also the third measure comes in, where public sector enterprises have again been offered discounted hedge. Now, here they are not taking away the full hedge cost, but they are offering some discount. We don't yet know how much, to basically raise ECBs from the offshore market. So that also should get some flows into India, some dollar flows into India. But the big one here is basically the FCNR 3 and 5 year, where RBI will cover the full hedge cost. And the last, which is also relevant, is that exporters uh, basically were given up to 15 months to bring their offshore receivables onshore. That has now been cut back to 9 months, which used to be the case before. So market expects, and this is something that we heard, we don't have any primary knowledge of this, but market expects $1 to $2 billion per month of additional flows to happen, because exporters will now have to bring forward the booking of receivables onshore. So all told, and again, this is market guesses because people will still be doing their numbers, etc. But generally speaking, between 60 and 80 billion dollars can very well happen in the next 3 months because of all these measures. And all the hedge discounts that RBI is offering expire in September. So there is a time limit to how much time people have to bring all of this money, which is a smart move, so that things will happen quickly. So, in some sense, this financial year's balance of payment issue the RBI has entirely addressed. And given that the rupee was already very beaten down and was basically looking for a narrative for it to shift, this could potentially also shift a bit of the narrative on the rupee, apart from the direct benefit it will get from all the foreign flows. So, in summary, and going back to the framework that we discussed, these set of measures announced today basically are a very strong statement of intent from both the sovereign, which is the government, and the RBI, that they are now completely seized of the balance of payment issue, and they are going to roll out steps so that this pressure is alleviated from the system. And there's no reason to believe they will not be successful. We fully believe they'll be successful, and with this success, a lot of the pressure on the domestic funding market will come off. And even as RBI hikes rates, the valuations on a host of rates in the marketplace, be it money market to corporate bond to duration government bonds, are actually looking significantly attractive to us. Now, there are two additional points that should be discussed, which are both variables and which have the potential to inject some volatility either side. So it could be negative or positive volatility. First is the obvious one, which is cessation of the war. So there seems to be a lot of chatter that and that is also reflected in oil prices, that the two parties are now much keener to get some sort of a deal done. And should that happen, and let's say oil goes back to the 85-90 zone sustainably, then that would ease a lot of pressure from the funding side, which will complement RBI and Government of India measures. It is also to be noted that in the revised forecast, RBI is assuming $95 on oil. We are pretty much there. The second thing, which from India's standpoint would be of great benefit, is if there is some tiring out of the AI allocation theme. Now, this is completely not in our expertise area. We are only noticing the evolving narrative there and share prices of some of these companies. But if, owing to additional supply of bonds and equities in this theme, if concerns with respect to rising token costs, or something like that were to start to fatigue the AI theme, so that global capital also starts to then look at alternate themes, then that would also be an important tailwind, which will supplement RBI and Government of India measures to shore up the rupee and capital flows into the country. So to summarize, before we open for questions, the number one issue for India over the last 2 years has been the balance of payment deficit, largely owing to higher global rates and competing capital themes globally. This is the first and a very substantial major measure taken by both the government and RBI to address this issue. And we think with these measures and hopefully other ones, depending upon how successful these ones are, the BOP issue indeed can be put to the back burner. And with that in place, market interest rates, which have risen so substantially, largely reflecting the funding pressure issue, look quite attractive. And we would continue to expect RBI to hike rates in a gentle fashion to respond to inflation. But that, with the current bond valuations, is almost immaterial. Now, in terms of portfolio strategies, like I said at the beginning of this call, and as we have been updating investors through market commentaries regularly, we have been very actively managing duration through the last 6 months. We have cut aggressively a couple of times when we thought risks were rising. However, over the last 15, 20 days, we have again added back most of what we had cut, so that across portfolios almost we are overweight duration. Our preference remains corporate bonds and money market instruments up to 3 to 4 years, and 14 and 40-year government bonds, so 14-year and longer government bonds. And both of these we think are very attractively priced if the sequence of events from here continues the way we just outlined now.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.